Hello, RWorld, and welcome back to another episode of RWorldtalk. I do have a personal friend on the show today, Mr. Derek Fertig. Welcome.
Thank you.
So, Derek, you are from Fairway Independent Mortgage Group.
Yep.
And
Fairway Independent Mortgage Corporation.
Fairway Independent Mortgage Corporation. God, I should have known that.
Fairway.
You go by Fairway. Funny enough, for just some background, so the listeners know what's going on. I had come down to Florida and decided that I was going to open up my own brokerage right about the time that you decided that you were going to go on your own and open up your own. Well, you wouldn't call it a brokerage. What would you call your mortgage company? Branch.
Yeah.
You were going to open up your own branch when I was opening up my own brokerage. So we've been sort of running on the same treadmill for the last quite a few years.
A long time.
Yeah. I've seen you reach incredible success. You certainly have really happy clients. We know that every time we talk to somebody that works with one of your people, they're always very, very happy with the process. But you've been in the mortgage industry for a while, a lot longer than the time that you've owned your own branch. Why don't you tell us a little bit about how you got your start?
Try and condense a story. Went into the Marine Corps straight out of high school.
Thank you for your service.
Yeah. Straight out of high school. Got recruited. I worked in the Pentagon for the Office of Secretary of Defense. I was doing IT stuff.
Okay.
And this is like 2002 at this point. Had a buddy that was in South Florida doing loans. Literally could barely spell and was killing it.
Okay.
And was just talking to me all the time. Oh, you need to move down here. You need to move down here. You need to move down here. And it just got to the point where I was like, you know what? If this guy can do it, literally. And in 2004, that was true. Anybody could do it. And so I just had a couple bad weeks at work and went to my boss and I was like, hey, man, I got this other opportunity. And it is not in a competing company. It's completely outside of the IT space. If I was to fall on my face, would you hire me back? And he's like, of course. And I was like, sweet, I quit.
See you later.
Yeah. I literally went back to my desk and typed up my resignation, sold all my stuff on Craigslist, packed my car, and moved down to Florida.
Okay.
And, that was the end of 2004.
Craigslist, that's a throwback. You just dated yourself.
Yeah.
Well, yeah, back then, I mean, I think basically all you needed was a pulse in order to get a loan, and sometimes that was not even a prerequisite.
Yeah.
Well, you know what? It's so what's going on in the mortgage industry now? Obviously, things have really tightened up. Those days of anybody being able to get financing and, people in high school buying $1 million houses is like now out the window. So looking into 2024, what are we looking at? Well, how's the market? Is it slow, steady, or are your phones starting to ring again? Because I know we rounded out last year. It was kind of looking a little bleak, but I know some people's phones have started ringing, which means buyers are back.
No, for sure. I mean, it's also important, like some backstory. I don't produce at the same level my role has kind of shifted. My career has taken more, like similar to yours, right? Like I'm in a leadership path now. So I am in a growth mode and I'm in a mentorship mode. So I don't have what do you call it? I don't get the at-bats that like Adam gets, for example, right? But I'm talking to our folks all day. I mean, that's really kind of my shtick is making sure that we're doing everything that we can to help them have the highest level of success possible. And I produce a little bit, nowhere near what I once was. Like when we first met, it's impossible to produce at a high level, manage at a high level, grow at a high level. You kind of have to like pick your path a little bit. So my path just led me down leadership. So I'm not going to have the same pulse. Right, let me rephrase. I'm not going to have the same sample size that somebody that does nothing but loans is going to have. But it's also important to note, like when people say, "Oh, it's slow compared to what?" Slow compared to the 2 best years ever that set the benchmark for what busy is.
Right.
That's an unrealistic pace. You know what I'm saying? So when people are like, I talk to people every day and they're like, oh, in 2021, I'm like, dude, it's literally 2024. It's like January 2024. Why are we talking about 2.5 years ago? But those benchmark years set brain levels for what success is. And it's like, you can't win championships every single year. It's just not sustainable. That's the expectation, but that's not the outcome. So, is it slow compared to 2021? For sure. Is it slow compared to 2018 or 2019? No. It's busier than 2018, 2019. And I think that pre-COVID levels, when rates were essentially free and the government was handing out money and you could over borrow and you could overextend yourself. I mean, you have to ultimately think about putting yourself in the position of a consumer. You're looking at competing for a house because work from home was a thing, or at least was a lot more prevalent than it is now, right? And people could work from wherever they wanted. Florida, really nice place to work from home.
Yes.
Yeah, I mean, overpaying for a house by 50 grand. They talk to their loan officer and rates are at 2.5%. They're like, so my payment goes up $100. Yeah, let's do it. You know what I mean? Like, and that's not the case anymore. So has that given some pause? Yeah, but I mean, we're tapering into a regulated interest rate market level that is back to where things were, maybe a little higher than 2018, 2019, but people soon forget that in 2018, 2019, rates were 5 and 6% then too.
Right. Yeah, and rates fluctuate not even on a daily basis, but throughout the day.
Hourly.
You guys get alerts. Hourly.
All day.
Okay. So I'm going to ask you about rates, but as a little bit of a disclaimer, the rates that we talk about right now at 8:00 on a Friday morning might be different by the close of business at the end of the day. So don't hold us to these things if they're not there.
But quote.
Yeah, we're not quoting. But we're seeing more interest. At least it seems that we're seeing more interest from consumers now that the rates are starting to weeble wobble and get under that 7% mark, and I think that people seem to be comfortable with the new norm.
Yeah, I think a lot of blowback, for a lack of a better term, in 2023 happened. You know, if you just look at data, rates went from, let's just call it 2.5 or 3% in 2020 and 2021, and then even at the beginning of 2022, I mean, they were in like the high 3% range. So you started to feel it, but this is Disneyland for a mortgage originator.
Right.
A rate with a 3 in front of it for 30-year fix is crazy. And then things started to ramp up at the end of 2022. That started off into 2023. And the thing that ended up happening was the exact reverse of it coming down so fast in 2020 and 2021. It went up so fast. So you had people that are in the market shopping for homes in January of 2023 that are like, okay, cool, my $500,000 house is X. And then by the time they find something, because there's not a lot of inventory, right? But by the time they find something and by the time they go under contract on something, that payment is like 30% more.
Right.
So they're like, one of two things realistically. Number one, that's not affordable for me. Or number two, I feel like somebody's kind of pulling the sheet over my eyes. So let me hit pause and just kind of wait this out and see if this is going to stay. So now we're at like a 12-month period of elevated interest rates, or at least higher than what people were accustomed to for that 2-year period. And I think what's happening is people are like, okay, this is just, it is what it is. So I'm not saying that it's a one size fits all by any stretch of the imagination, but you know, somebody that is like, you know, pre-qualified or pre-approved in December of 2022 at 4.5%, and now it's at 6.5 or 7%, that think that they're getting ripped off, or that the mortgage company or the originator is controlling the interest rates, are now like, all right, I've kind of evaluated this for 12 months and this is holding steady. So yeah, let's go ahead and move forward.
Yeah, we're going to start talking about the millennial home buyer generation, which makes up a huge portion of the market right now. But I've often had thoughts that, you know, being a first-time home buyer, being a millennial, you've not gone through higher interest rates in the past. All you know is growing up with the pandemic and 2% and 3% interest rates, and now they see, you know, when the 7s and 8s came around, they're like, my God, I'm not doing that. I'm going to wait for the rates to go back down to 2.5%, 3%, which that's not something that I'm sure you as a loan officer ever expect to see, unless we have some sort of other catastrophe that comes our way in an economic sense.
Right. Realistically not. I mean, but I mean, the thing is that I never thought that we'd see those interest rates.
Right.
I mean, in 2004, a great rate was 7.5, 7.8. I think the first loan I ever closed was, the guy drove from Marathon to Fort Lauderdale if I could get him under 8%. And I'm new, I'm cutting my teeth, but I was like, yeah, come on up, right? Because we did everything in person back then. There was no DocuSign or anything like that. It was all the belly to belly, and you're physically signing paperwork across a desk from somebody. He literally got in his truck and drove from Marathon to get 7.875. So it just puts things in perspective. The problem is, or I wouldn't say problem, the challenge is understanding the knowledge base and the sample size of your consumer. People that have been in the business for 20 years and have been through cycles and cyclical markets, we understand that. Somebody that's 25 that was in college maybe, or getting out of college at the beginning of the pandemic, this is all they know. So it's like, people say, well, you use a term, oh, that's expensive. Well, what's expensive? What does that mean to you? Because I could ask person A and $3 is expensive, and then you go find a billionaire and $1 billion is expensive. So you have to understand who it is that you're communicating with and finding ways to educate them. Because I talk to so many loan officers and so many people in the business, and their perception is that it's just ridiculous, but it's factual to them. That somebody that was in the market or looking at purchasing a home 3 years ago, a 7% interest rate is expensive to them. But for somebody that had their first home in the 80s and they had 15% or 18%, 7% is a steal.
It's a steal.
So it really depends on who you're talking to.
Okay, so let's look into crystal ball for the end of 2024. We're hearing a lot about, interest rates should continue to come back down throughout 2024. I'm not the one saying that. These are the people above me that I listen to. So I'll ask your opinion on that. But do you think that we can expect to see a strengthening market down here in South Florida? And do you think that the rates are going to continue to drop as they say that they should?
Yeah, I'm piggybacking off of what you said, but nobody has a crystal ball. All of the data that we had in 2023 indicated that in May of 2023, rates should have fallen, and they did the exact opposite. So everybody in the loan officer space and mortgage space was actually gearing up and being told and hyped up that 2023 was going to be a banner year, because while we got battered at the end of 2022 and the beginning of 2023, when the inflation reports came out in May of 2023, it would have been a 12-month rolling where it was the first time. Keep in mind, 2020, 2021, 2022, inflation was essentially zero because the government was keeping everything at essentially zero.
Right.
They're fabricating that. 2023 was the first anniversary, for a lack of a better term, to where you would have had a 12-month rolling number of inflation being higher. Well, it's always going to be higher compared to zero, but it would have been normalized. And so it would have been the first opportunity for a 12-month tick for where inflation would have dropped. And then everybody was forecasting. I mean, and all mortgage companies and all mortgagees and all loan officers really rely on like 2 or 3 main sources for their information, and they're all saying the same stuff. So should we see it? Yes. Will we? We were thinking we were going to see that in May of 2023, right?
Right.
But
that was due to the job numbers that they expected, or the job numbers ended up being much higher than they expected, and inflation didn't come down as much as they thought it was going to.
No. So it did, but we could do a podcast on just that, on what actually happened, but it was a perfect storm. It was a perfect storm of inflation data and several other key indicating points. But yeah, I mean, the real number was, I think it was May 10th, actually, of 2023. The CPI, which is a consumer price index, would have updated for a 12-month rolling where you would see inflation as, I'm just using an example, right? But let's just say it's 5% or 5.5%. And it was going up month over month because the year prior, which was 2022, was at zero, essentially, right?
Gotcha.
So May of 2023 was the anniversary of when inflation started to tick up. And then so May, June, you're starting to compare rising numbers versus what they actually are.
Gotcha.
And inflation did indeed start to dip. And rates should have come down.
So is that why everybody's using every report that I've heard, when they start talking about the rates falling, they keep using the month of May? Is that why? Is because they're going to go and use another year and see what that looked like, where it wasn't artificially?
Yeah, I would think so, because now Then, you also have an X factor that this year is an election year, and just weird stuff historically happens on election years.
Sure does.
Gas gets really cheap and the stock market gets really high and real estate does really good and rates go way down. So I think that's another thing that people are kind of hanging their hat on. Who's to say? Is that going to come true? Don't know. Would it be great for both of our businesses? For sure. But will it actually happen? We don't know. I mean, we hope that it does, but...
All right, folks, you heard it right here. You can hang your hat on that one.
You cannot.
Okay, so obviously we've gone through 2023. Business got a bit tough. Actually, 2022, 2023, end of 2023, we saw some squirrely stuff happening. But when business gets tough, how do you cope? How do you stay positive and continue looking outside the box? Do you have any tips for our listeners?
Yeah, the best thing that I could say is that you have to understand that everything is a season. Spring doesn't last, summer doesn't last, even winter when it's super cold. I mean, we don't have a bad winter here, right? But you talk to the people.
But it was cold when I woke up this morning.
Yeah, I mean, cold goes back to the subjective, right?
Right.
Cold to who? Cold to us. But if you talk to people in Buffalo or Pittsburgh, where I'm from, and Buffalo's where you're from, 60 is not cold. They're they're walking around in shorts and tank tops.
Yeah, exactly.
So it really depends on what that is. But, toughness is a season. When it's good, it's good. And when it's, when things are good, you're feeling like you're on top of the world and you can't hit anything but home runs. And then when negativity seems to spread a lot faster than positivity. So whenever things seem to go through a down cycle, people are just kind of like hemming and hawing. And I feel like what a lot of really good tenured veterans do is they remind themselves that this is not going to last forever. At some point, this is going to turn. The one thing that we don't know is how long is this season? Is this 3 months? Is this 6 months? Is it a year?
Right.
Relatively speaking, those are short periods, but they can feel like forever when things are tough. But when they're good, the good periods usually are 2 times or 3 times longer. I mean, you look at really the last down market that we had, that was like 2013 was a little bit of a blip. And then from 2013 to basically 2020, beginning of 2022 was nothing but ascension. So you talk to anybody that was in the real estate business, you had a decade of just perfect storm.
Right.
And then you have a year of winter. So when we're talking to our team, and even I'm reminding myself, would I trade a year of a down market for 10 years of a good market? It's a pretty good trade-off.
Hell yeah.
Yeah. So it's you have to remind yourself of that sometimes. It can easily become woe is me mentality, but we also have really great leadership. So we're able to bounce ideas off of other people inside of the company. We're definitely not on an island by ourselves. The CEO is fantastic. He does an amazing job. So, attitude reflects leadership and everything kind of just trickles downhill. So if the top of the totem pole is positive and forward thinking, usually everybody that is on the bottom side of that totem pole or at the bottom of the hill is going to just gobble up all that positivity.
Yeah, I've actually been lucky enough to be at a couple of your company's national events.
Yeah.
And my gosh, the caliber of speaker and the caliber of leadership that you have within that organization is absolutely incredible.
Yeah, it's I mean, we're super blessed to have found the opportunity that we did when we did.
Right.
But yeah, it's second to none.
So getting back to millennials, we're hearing that the millennial generation is now dominating the market. The last numbers that I heard, it was over 40% of buyers right now are from that millennial generation. We're also reading that they need help with down payment assistance. They're in the middle of an affordability crisis.
Yeah.
So which is it? Are they dominating the market? Are they not able to come up with the funds in order to close? And what kind of demographic stats are you seeing in your market area, which you serve several markets, correct?
Yeah, we're you're talking about our team or Fairway in general?
Your team.
Yeah, same as you, Palm Beach, Broward, into Dade a little bit, but mostly Palm Beach and Broward. I mean, it's kind of like all the above. Just as the unaffordability thing is it's almost a perfect storm. you know what, you have the millennials that are entering the marketplace, and they are on the tail end of nothing but ascension from a price perspective.
Right, massive growth.
Yeah, I mean, dude, you look at how many clients you know that bought their house in like 2020 or 2019, and it's doubled or tripled in value. Right. So now that person that purchased in 2019 is killing it. They're going to sell. And that is now that's a high exit point for them and an ultra high entry point for a millennial.
Right.
Well, dissimilar from the person that purchased a house and is now selling, the millennial is now paying 2.5% on interest. So you're getting this whip effect.
Your monthly payments like skyrocketed.
Again, compared to 2019 for sure.
Right.
So, it's tough. You look at like the year over year, how much housing values have increased. I'm going to get this number wrong, but I saw something like some data tile or something like that, where it's like 167% over like the last 5 years, whereas incomes have only raised like 40%. So you have an affordability problem. On top of that, you have an inventory problem. So it's like, this is economics 101. Supply and demand.
Right.
If there's no supply and all the demand, the price point is going to be higher for whatever it is that you're trying to sell, whether it's a house, whether it's a car, whether it's a hamburger, whatever. Right.
Milk is so expensive.
It's the truth though. So it's like, there are programs that are coming out that are bridging the gap from a down payment perspective. And then some of the programs on top of that will subsidize interest rates. So there's a lot of like Broward housing programs and Palm Beach housing programs and stuff. A really popular one this summer was the Hometown Heroes, where they opened it up. You know, they had like $100 million fund. And the previous year it was, the business had to be in Florida.
Right.
You had to meet like all these key points. And I don't think that they got the capture that they were looking for. So they opened it up to basically everybody in Florida. You just had to live in Florida and be a first-time home buyer. And that 100 million like evaporated in 2 months. It was like 75 days. That 100 million was gone.
Yep.
Yeah.
Yeah, we're expecting another 100 million to be pumped into that program at the end of this session when they finalize the budget, which would be great news for anybody who's looking to tap into that. And you guys obviously are well versed in using the program. I know that you've been doing reserving quite a bit of those funds.
Yeah, well, the state of Florida has its own programs, and then each county and sometimes even its own municipalities have programs. So like Fort Lauderdale has programs, Davie has programs, Cooper City has programs, Miramar has programs,
right? And
then Broward County has programs, and then the state of Florida has programs.
Can those be stacked?
Yeah, no. So they're individual. You can't do like, at least unless something has changed as of, what's today? January 28th right. or 29th or whatever. Yeah, I mean, I'm not aware to where you could take, now you could get a grant from some type of third party institution and then utilize that for a first-time homebuyer program for sure. But you couldn't get like a first-time homebuyer program where you're getting a DPA or down payment assistance rather from, let's call it Davie, and then pair that with Hometown Heroes and also get more down payment assistance.
Okay.
Yeah, it's like, it's choose your
poison.
Yeah, there you go.
Okay. So let's talk more about, well, you know what, following up on that, are you seeing an increase in what that millennial buyer is being paid? We have a lot of people that are moving from out of state down to Florida. When you're looking at that demographic and you're looking at, your sample size of buyers that are coming in, obviously these prices that we have in South Florida are way higher, like you've said, over the last few years and just keep going up. But are you seeing that people are actually getting jobs that are paying them a heck of a lot more when they're moving down here?
What I'm seeing and talking
from future generations,
talking to the team and the loan officers, they're having a lot of people that are transferring, not necessarily getting new jobs.
Okay.
And that could be good, like if they're coming from California and New York, like super high metropolitan areas where maybe the cost of living and even these cities that are exploding, like Nashville or Austin or something like that, a lot of them may have the ability to work completely remote or telework. Okay. That's beneficial. And they essentially get a net raise because aside from like Texas, and there's like 6 or 7 states in the entire country that don't have state income tax. So you take a buyer that's coming from California that works for Google or Meta or Amazon,
making more money,
killing it.
Yeah.
Right. So again, it goes back to the affordability for basically everybody else, though. It is slightly unaffordable. And what's interesting is that
struggle is real.
Yeah. And where it can make it more challenging too is that rents are a little less than owning. So it can be very easy to be short-sighted to where people can say, okay, I've got two options. I can go into an apartment for, let me sign a 12-month lease or whatever, and just using example numbers, I'm paying $3,000 a month for rent or $2,500 a month for rent. Or I can own the home and it's going to cost me $2,900 or $3,300. The people forget, and I feel where, and I'm not knocking on people, but I think that what ended up happening is that the surge of business in 2020 and 2021 took the art of loan origination away, meaning that you're less consultative, more transactional. So there seems to be, it's getting back to it now, but even talking through like the recruitment process and looking for people to join the team, you're just understanding like where their business is coming from. There was so much that people shifted from an educator and an advisor to
data entry,
almost like an order taker a little bit. And it's not a knock on anybody because you almost had to be. You had to figure out like, I have 10 pounds of clients and I have a 5-pound bag. Right. So it's like, I need to be as efficient as I can. I need to spend the least amount of time with each individual borrower, each individual client. And those habits kind of stuck. And when things started to dry up, rates went up, there's less demand, there's still the inventory challenge. People are not, or they're a little bit more resistant to get back to their roots of educating people and say, hey, let's before you hit pause, let's do like a buy versus rent analysis.
Right.
Just using hypothetical numbers, right? I want to make you or help you make the best decision that you can for yourself. Sometimes that means seeing the forest through the trees or seeing 3 years down the road or 5 years down the road. Most millennials, their first home will not be their forever home.
Right.
It's an entry point. It's like your first job is not going to be your forever job. You're going to use that to stair step into something that you really want. You can sell a house, you can't sell a rental. So I heard this quote one time and it's great, but the interest rate on rent is 100%.
Yep.
So, I mean, when people are saying, oh, the rate's high, well, is it lower than 100? Because that's ultimately what you're paying in rent. So I understand.
Paying off somebody else's mortgage when you're renting.
Or even you're paying, you're renting at one of these big apartment communities, right? Where that's another thing is that people forget that when you get a 30-year fixed mortgage, you're essentially setting a fixed portion of your entire budget in stone for as long as you keep that mortgage anyways. You hope the rates drop and you can reduce that. But if you're renting every year for whatever your lease period is, next year you can almost bank that they're increasing that rent. I mean, every single year, especially downtown Fort Lauderdale. And we have people on the team that are renting where they're coming in and they're like, my rent just went up 25%. Like, wow. Dude, could you imagine? Like, let's put that in. Have you ever heard of a mortgage where it's fixed rate to where somebody comes back and they're like, yeah, I was paying $2,500 a month and my mortgage is going up to $3,200. And then it's going to go up to $3,700 next year.
That's crazy. You'd have to sell your house.
It's insane. But people, at least from the conversations that I'm having and what's being shared, is that people aren't looking at that. They're looking at just what is the payment right now. And this is what's more affordable. So when you start comparing those things and you can utilize some of these tools that are out there and educating the customer and saying, my Lord, you're walking away from, even in a down market, double-digit appreciation every year, that $300,000 starter home is going to be worth $450,000 in 5 years or 4 years, whereas your rental is going to be worth zero. Right. So you can pay a little bit more, which, by the way, you'll be able to take tax deductions on the mortgage interest portion as long as it's under $750,000.
Plus, you're paying down your principal.
It's decreasing every month, so you're building appreciation. And honestly, like, appreciation is free money. I mean, it's paper money, but it's free money for doing nothing other. You're gonna have a housing expense regardless. So would you rather make money for just paying your housing expense and then be able to sell that and then snowball that into the next purchase?
Right.
You know, so it's, I think that people have kind of gotten away from, for a period of time because they had to, the art of the consultation, the art of being an advisor, the art of gaining trust and actually setting people up for success and mapping out a plan. It's just become, what's your rate?
And building a client for life.
Oh, for sure.
Yeah. So let's talk about what makes your company unique and what makes you guys stand out from your competition. One of the things I remember when I went to one of your national events, you guys always on Fridays, you have Red Fridays.
Red Friday.
Tell me about Red Friday.
Remember everyone deployed. So we're a big advocate for veterans, active duty military. So we have a couple of nonprofits. One of them is American Warrior Initiative. It's ran by this amazing person in the company, Louise Thaxton, and kind of like our claim to fame in that regard is that we rate, so it's funded almost exclusively by donations from people that work inside of Fairway. Oh, wow. So like every paycheck I get, I'll donate X dollars towards American Warrior Initiative. Not only me, but like I think Fairway has 6,000 employees as of today. A huge chunk of them will. And what they'll do is they give away service dogs to veterans or retired service members that are in need. Like these dogs literally save these people's lives. I
remember seeing the stories. And there was not a dry.
Well, you were at the last
conference room.
Yeah, you were at the last
convention hall.
Yeah, it's really, really powerful.
It is.
But it's just cool. It's, we have company calls on Friday and you get on and the whole leadership team or the whole executive team's wearing their red t-shirts and everybody on the team wears red in the branch on Fridays. It's just, it's something, it's like a jersey, you know what I mean? Right. It's everybody is really proud to wear that. And it's something that's bigger than just yourself or doing whatever it is that you want to do. It's cool.
Yeah. Certainly things like that always make us feel good. And as well builds a level of camaraderie within the office, I'm sure, that everybody gets together and remembers everyone that's deployed. I think it's a fantastic initiative that you guys have started there. If you were to provide one specific tip to realtors, what would that be and why?
That's such a good question.
Because you work with so many different people.
I think that as of right now, it's such a good question because it changes literally from year to year. I have never seen in my career at this point realtors be so involved in shopping interest rates.
Interesting.
It really is. And look, at the end of the day, a realtor wants to create an amazing experience for their customer as well. It's literally the lifeblood of both of our businesses.
Right.
It's like, how do you make that experience a 10? From a buyer, having a realtor where you feel like the realtor's advocating on your behalf to make sure that the buyer's not getting taken advantage of, I'm sure feels amazing. The problem,
it's not always about the rate.
Yeah.
If you're looking for good service.
And this isn't a, we don't have high rates, by the way. In fact, we just did a rate reduction. So we're ultra competitive. But as you know, there's always somebody cheaper. And in a down market where people are willing to do anything to bring a deal in the door, the fastest way usually to do that is make your product cheaper. I remember one of my first mortgage jobs, I was a broker. And I'm telling you this because I'll answer your question in a second, but there's a backstory behind it. One of my first jobs was a broker, and we used to send virtually all of our business to this one wholesale lender. And we kind of created a business off of that, just kind of like understanding the nuance behind how they underwrote, how they took incoming applications, how they closed, how they funded, etc. You can kind of set your watch by it and you know what to expect if it's 75 or 80% of your fulfillment. But every now and again, like let's say I'm a loan officer, you're my customer, we're communicating back and forth and I quote you and it's Monday, right? And you say, all right, let me sleep on it. I'll let you know tomorrow. And then you call me back tomorrow and interest rates change slightly every day. But then the rate is like 0.5% higher or 0.75% higher, it does two things. It makes you lose faith in me, and it also kind of stymies my business. Now I have to figure out how to reallocate everybody that was in my pipeline that I had initially earmarked to go here, potentially somebody else, to maintain trust with my customer, to make them feel like they're not getting ripped off. Okay, so I asked the lender, like, why are you doing this? We're too busy. And the fastest way to turn off business is to make your price higher than everybody else's. We can't handle it. So I'm sitting there thinking to myself, I'm like, okay, the exact opposite happens whenever you need to drum up business, because I would notice that it's cyclical with them too. As soon as they would get through the pipeline and they would be back under like their service level agreements, they'd blow everybody's doors off on interest rate. And I'm like, holy smokes, their rates are ridiculous. Loan officers in essential or companies have the ability to do the same thing. And where I'm going with that is that if you're a realtor and you have a trusted relationship with somebody, there's usually years of experience and outstanding performance associated with that relationship. I've never, ever, ever, ever heard anybody refer anybody and be like, call this guy, they suck. They're the worst. They don't respond. They're like super expensive. But I like him, but he's gonna generate, or she's gonna generate, a terrible experience. Right. But it's my dog. He's my next door neighbor. Right? Like, it just doesn't happen. Right. It's usually based off the ability. The loan officer's thought process is that the loan officer or the lender is an extension of the realtor's business. It's a value add, not a value subtract.
Right.
So how are they able to position themselves to make you as the realtor look their absolute best, understanding that most borrower inquiries or new homeowner inquiries or new home purchaser inquiries start with the realtor, not with the lender. We have realtor.com and Zillow and all this stuff. People lay in bed at night and they're like, oh, look, honey, look at this house. They're not like, oh, look, honey, look at this interest rate.
Right.
Ever. I've never, ever seen anybody. I've done tons of open houses, especially with your team, tons. Yeah, there's 0 times somebody's walked in and they're like, I could really see myself borrowing money here. It just doesn't happen.
Right.
But they get emotionally attached. Yep. And they start to see down the road and they're like, I could see us raising a family here, or this is close to work, or this is close to the things that we want to do. So they start selling themselves, and then they reach out to a realtor, and then a realtor says, okay, happy to help. What's your budget? Yada, yada, yada. Kind of goes through the procedures. How do you intend to pay? Are you going to pay cash, or are you going to finance? Oh, we're going to finance. Okay, I have a great person. And then what ends up happening is that I think that a lot of people are still stuck in 2020 and 2021. So they see a number on a pre-approval or a payment or whatever, and then they themselves start to question. And they inadvertently give the consumer bad advice by telling, you should shop. So I'm prefacing with that. You don't want to just get blindly just trust or blindly just take whatever.
Right.
But you also want to get a benchmark as to like what's out there. Sometimes, the best customer service and the best businesses in the world are set up to scale. Usually not the cheapest. Very rarely will you find a perfect storm where somebody that has the ability to service a client at the highest level possible, be able to step up to the plate and take care of things that they need to so that they're contractually fulfilling their obligations and close. It doesn't necessarily, because everything's fast right now, but just consistently day in and day out outperform, also be the cheapest.
Right.
You have to think like business 101. If it's cheap, there's little margin. If there's little margin, there's usually nothing left over for things like support. And I'm not saying that that's not a ploy or a sales tactic in any stretch of the imagination of where consumers should feel, oh, I need to overpay. That's ridiculous. But what's ending up happening is that they may tell a borrower to go online, and then they end up with somebody that has done 0 loans in Florida with an online lender in Iowa. They have no fulfillment. They don't have any appraisal relationships down here. And by trying to save 0.1% on an interest rate, they get a team that has no clue about local market. They have no local appraiser relationships, inspection relationships, insurance relationships. Huge thing right now. And then they ultimately end up overpaying.
Right.
Appraisal comes in low. They're working with some national insurance company that doesn't have local Florida carriers or something like that knows the nuance of the South Florida market. And yeah, they may get 0.1% lower in interest rate, but the appraisal comes in $25,000 lower and they're overpaying, or they're coming out of pocket more, or their insurance is $2,000 a year more. All these things can add up to not hitting expectations that should be hit straight out at the gate.
Yeah, there's a reason that we put these teams together as realtors to make sure that we've got the best of the best in our corner, helping out any consumer that comes our way. And there's a reason why we work with the team that we work with.
Yeah. And that's not an advocacy for Fairway in general. I mean, it should be. But what I mean is that if you're a realtor and you're watching this and you have, I mean, I'm friends with so many good loan officers at so many good companies. There should be like a synergy and a level of trust there. Is like, help the loan officer understand what the client feedback is. Hey, before the client goes, we may want to huddle and talk with Chris because he's feeling like the interest rate is a little high. Why is that? Again, going back to the consultative approach, so many loan officers that I see even on social media, and we're going through the recruitment process of what it looks like to join Fairway. I'm doing deep dives on their business, how they're getting it, how they're servicing their clients. And they're like pulling credit, verifying income, and then just setting a pre-approval. There's no, hey,
income verification.
It's not even that. It's like all of the things that go into a recipe of what equates to getting approved, and then what the payment is too. It's like, hey, you don't have 780 or higher credit, which opens up best interest rates possible. So the stuff that you're seeing online is best case scenario.
Right.
You have a 660. There's a lot of hits to your interest rate for that. You're buying a condo. There's a lot of hits to interest rate for that. You're putting down the minimum. There's hits to the interest rate for that. So if you are comparing, we want to make sure we're comparing apples to apples, because a lot of times people will just say, hey, I got a first-time home buyer and they're putting 10% down and they price it out. Best single family, 780 credit, and then they get a lower interest rate and they're like, see ya. And then 3 weeks later, it's like, surprise, surprise. The real numbers come out. It literally happens every day.
It does happen every day. Well, we know that you're a busy guy. You've got a big office and team to run. So I'm going to ask you one last question, which we ask of all of our guests here on RWorld Talk, is tell us about a South Florida gem, something that you absolutely love about not living in Virginia, not living in Pittsburgh, but living down here in South Florida. What's something that everybody who's listening has got to check out at least once?
Business?
Could be it could be a bingo hall, or it could be a restaurant. I don't know. Or a favorite beach spot, or whatever it is that you do with your family that you absolutely love.
Family and hidden gem, two different things.
Okay.
All right. Family stuff is literally if you're visiting, rent a golf cart and go to the beach. Like the beaches here are awesome, but the golf cart experience, being able to drive up and down A1A and all the parking and all that stuff on the beach, being able to park the golf cart near the beach and then just take your stuff off and camp up. Even though I'm not the biggest beach person, every single time we do that with the kids, they love it. And it's amazing. It creates memories.
I do that every time I get on the golf cart. I go, why don't we do this more? It's just sitting there.
All right,
in the
we'll
garage.
come back in 6 months.
Yeah, right.
It's not even a hidden gem. One of our favorite places to go, though, if you like Italian food, Cafe Martirano.
The place gets wild.
You know what? It's just, I had a different experience when I was in my 20s because I wouldn't go out until it almost closed, right?
Yeah.
Like, we wouldn't go out until 11, and now I'm asleep.
The place is all dark with the lights going. You can't hear yourself talk.
Dude, the food's just so good. Like, I've never gone there one time and been like, oh, this is terrible. Or I wonder what's changed. It's consistent and it's amazing.
Which spot you go to? Oakland and A1A?
Yeah.
Okay.
Yeah.
There, you guys heard it right there. Well, thank you, Derek, for joining us.
My pleasure, dude.
Thank you guys for listening, and we will see you all right back here next time on RWorld Talk.